Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and we have a really interesting guest today from across the pond in London, England, Andrew Lees. Andy, as I call him, who is the partner in Macro Strategies Partnership, does some really great research work. For any of you pros watching this today, I would highly encourage you to take a look at their work. They do a good job on everything. Man, Andy, glad to have you today.
Thank you very much. Very kind.
Yeah, I thought we'd start out, Andy, since we just came fresh off of the interest rate situation where Powell spoke yesterday, and see if you have any thoughts about that.
I think it's summed up perfectly by Zero Hedge today, wronger for longer. But I've been in this industry for 40 years, and I think you start off thinking the Fed and what have you know everything, they must have all the information, etc. And you're a young guy, naive. Over time, you gradually sort of change your opinion. And I personally just don't think the Fed has a clue what they're doing. And I'll give you a chart or a suggestion of how you can tell that. Just look at Fed funds rates over the last 20 years. It's not as bad going back, but certainly since 2020. 2000, base rates have basically gone from 6.5% down to 1%, back up to 6%, down 3-4 times. It's always using a hammer to crack something. And they're basically responding, and they're responding to the failures that they've made themselves rather than having a sort of fairly continuous constant rate. So when I look at what they did yesterday, so they indicated that there's probably one more hike, and then the dot plots say only 2 cuts next year. I personally think deflation is the big risk that we face at the moment, not inflation. I know that's obviously going to be controversial, but I think that's where we really are. If you look at monetary aggregates, etc., they're already showing that. The inflation that we've got is lagging. It is a result of what happened in 2020, the huge monetary expansion then, which at the stage was, it was about 28% year over year. It's now minus 3.7% year over year, which is the worst since the Great Depression in the early 30s. We've never had money supply falling year over year other than the Great Depression, 2021, and a little bit in 38 and 49. Otherwise, yes, on a quarterly basis, it's fallen, but not otherwise. So I think what the Fed's done is cause massive inflation. And now rather than stabilizing bringing the inflation back to zero or what have you, they're going to cause deflation. So they've taken nominal from 100 to 120. Rather than keeping nominal at 120 and growing from there, they're going to take it down.
Yeah, you have a good graph on that. You have a 3-month annualized CPI Bloomberg consensus that is basically just been going down, and it's down to the lower levels we've seen since 20. As far as CPI.
CPI. So CPI is again an interesting aspect. If you look at, I think again you've got to come back to looking at it from a monetary angle. So first of all, whilst the year-over-year figure of money supply is down, if we look at it on a shorter-term basis, 3-month annualized money supply, and you have to build this yourself because the Fed stopped publishing it on the short data. But you can do it easily. It's bank deposits plus retail money market funds plus currency in circulation. 3-month annualized monetary growth, basically from mid last year, been negative until the beginning of this year. Saw a small surge in Q1. And now it's having another surge. Otherwise, it keeps falling back. So when I say surge, it's up to about, the last figure was about 2% annualized, so not very strong. What caused those surges in Q1 and now? For money supply to grow, and this is commercial money supply, not base money, it's got to have productive demand backing it. Otherwise, the bank loans will not create return to pay for themselves and money supply will shrink. So it's got to be productive demand behind this. And I don't think that the money is being driven by productive demand. It's being driven by speculative demand. So in Q1, what happened was we had the end of COVID, lockdowns in China, so there was optimism. And we also had energy prices had fallen heavily last year, and in Q1 this year, they were down 3.7 percentage points, 3.7% relative to GDP, i.e. energy fell 3.7 percentage points of GDP. So that's a huge boost to the economy, effectively. So understandably, speculators said, well, China's going to grow, let's play the stock market. And so you got monetary growth, but there wasn't the productive demand behind it. So you got bank failures in end of Q1, and money supply collapsed again. Then this time, you've had the government spending. The debt ceiling was raised. And so there's been money piling in anticipation of that huge government spending, or being driven by that government spending. The money's come out of the reverse repo. Doesn't matter where it's come, but it's come out of there into treasury bills, financing the government spending. The problem is it's not going to be productive again because it's spending on renewables, which is effectively just burning up money as far as I can see, and we'll come to that later. But that then sort of implies, okay, the public sector is not price sensitive. So they're going to squeeze out the private sector on this process. And I think that's exactly what we're seeing, because energy prices have risen this last 3 months, 1.5 percentage points relative to GDP. So big squeeze on the household budgets, etc. Why? Well, obviously Saudi's withdrawn supply, but secondly, I think it's the government unproductive spending that's basically causing demand. They're spending maybe on renewables, but they have to be built. So that's caused fossil fuels to go up, and that's going to squeeze out the private sector. So it's the monetary growth that's important. Then bring that to, as you say, the CPI, the inflation. So Q2 GDP, nominal GDP. Nominal GDP slowed to 4.1% annualized in Q2. That was 2.1% real and 2% price deflator. So hold on a minute, 2% price deflator? I thought we were concerned about inflation. You got CPI, wherever it is, it's been around 3.5% for quite a long time now, if you look at 3-month annualized rates, etc. But you've got the broader measure, the measure they use to discount GDP, down at 2%. And you've got broad money supply, which is the broadest measure of inflation, negative. So this is when it starts to get, in my opinion, interesting, the story, because what's really happened is there's not productive demand for money, but how have you managed to get 4% nominal GDP growth if money supply is falling? And the answer is, well, the velocity of money picked up. So we go back to 2020, Fed printed huge amounts of money, but the economy was locked down. So it went into asset prices. Pile of money went into asset prices. So we had massive asset inflation. Over the last 2-3 years, that's gradually come out of assets into end goods. So you've had asset deflation, bond yields going up, financing end goods inflation. CPI does not include asset prices. Obviously, it works through the system gradually, but it does not directly include it. So it's a narrow measure of inflation. The broader measure is only at 2%, the GDP deflator, and the overall measure, money supply, is negative. This is the way I sort of see the world. So you've had money coming out of assets going into end goods, but even in that process now, you're not getting nominal GDP. Nominal GDP is 4.1%. How do you service 5.5% base rates with 4.1% nominal GDP growth? So if you're a bank and you want to make loan monetary growth, you know that at a system level, you're going to get a negative return from that monetary growth. So this is the problem that we really face. Money supply is falling, and it's going to continue to fall because rates are too high. And secondly, the velocity of money is going to start going down for various reasons, but one of which is US debt, government spending, has started to soar relative to GDP. So Q2 started to see for the first time for several quarters debt rise relative to GDP, which means more of the money is going into an unproductive thing because it's not creating a return to pay for itself. So that means velocity of money is going to go down. So that brings you to the very interesting issue of, hold on a minute, if money supply is going to go down, velocity of money is going to go down, where's nominal GDP going to be? MV was PT, should be going down. And if you look at Q2 nominal GDP, it's 4.1%, but that's an annualized figure. It's only 1% not annualized. If you look at GDI, gross domestic income, it's only 0.6% growth, nominal growth on a non-annualized basis. So it's quite easy to start seeing this going negative, I think. I think this is the real risk.
Not to interrupt you, but with that trend you're talking about, then I'm asking a question, not assuming. You would be thinking more along the lines of we're getting ready to have some negative quarters in GDP.
That's where I think the real risk is. Absolutely, the government spending, it's unproductive. I just don't see how, without lower interest rates, which you could have at any stage, but of course the Fed's saying otherwise. I just don't see how we're going to sustain this level of nominal, let alone real GDP. And therefore, how do you service your debt, etc. So this is the problem that I foresee. The Fed is way behind the curve, just as it was 2 years ago or what have you, and it's going to be the other way.
And now you see it, having an effect on you've always had some good grasp on the savings rate of individuals and what they're having, the retail sales, all that's fitting in with what you're talking about right now.
Well, what I would look at is, again, I put this into broader context. So I look at both the short-term stuff, but also the structural stuff. And that's probably more my interest. So if you look, a real GDP growth has been trending down for decades. Fairly steady decline. And you've got to ask yourself the question, why? First of all, it's backed up by productivity data. I use total factor productivity. So, the real productivity of the economy, that's been trending down. Energy production growth and energy consumption growth. Remember, the whole of GDP is effectively explained by energy. You can't do anything without energy consumption. So it all confirms that the data is trending lower. So the question is why? And the answer is quite simple, actually. It comes down to because energy is part of GDP, everything that we do has to create the utility to pay for itself. If it doesn't, it's by definition at the expense of capital consumption. And that's where we are, because if you're in the private sector, you're always going to want a better standard of living. If you do something that gives you a worse standard of living, you're going to stop doing it and go back to what gave you the better standard of living. The problem is the government does the opposite. So any government beyond sort of being the referee to stop the private sector corrupting itself, any government beyond that is by definition misallocating capital. So it has an ideology. It wants to support this person, but in doing so, because it's misallocating capital, it's lowering productivity and it's actually harming that person. It's lowering the system-wide. And that's what you can see, therefore, when you look at, you mentioned savings ratios, I would prefer to look at the net national savings and the gross and the overall investment ratios. Again, they've been trending lower for decades. And the net national savings rate has actually turned negative in the States. If you look at Europe, you'll find, most of these issues in the States are an opportunity cost of underinvestment, etc. So government's not too big at the moment. You look at Europe, we're basically at the stage where it's a real cost. We're just destroying the economy.
And so, so I guess what I'm hearing you say is you would look for Europe as well as the U.S. to have a continuing decline in the economy.
Europe. I'm glad you brought us on to you. There's a chart that I often refer to, which is the Eurozone share of world GDP. And it comes from World Bank or, one of the main bodies, so it should be relatively accurate. That topped out at 26% it was about the late 70s, early 80s, dipped a bit, came back to 26%, 26.5%, early 90s. It has then fallen to 2008, 22% of world GDP. It is now 13.9%. It has collapsed as a percentage of world GDP. Now, people will say, well, hold on a minute, that's because China's grown so strongly, which is absolutely true. But the question is, why has China grown so strongly and we've basically stagnated? It's again down to government policy. Total factor productivity in Europe, and I get the data from the US Conference Board, so I'm happy. They've got data for every country around the world. US Conference Board data shows total factor productivity for the Eurozone peaked, I think it's about 2000. It's fallen 10 percentage points since, and that takes us to 6% below 1990 levels. So can you imagine, over the last 35 years, we have become 6% less productive? And that is actually a sort of, it presents it in a good light, because we've had Eastern Europe coming into the EU, and Eastern Europe has seen strong productivity growth. So Western Europe has seen productivity collapse. And it's, again, government policies. The most obvious one at the moment is the renewable energy policy.
And they've changed, and I think you mentioned they had changed that just recently.
So the UK, yesterday, the Prime Minister, trying to sort of get up in the polls, he basically has postponed that for 5 years, the net zero target. Hopefully that will be the start of it not sort of being, continuing. Why am I so anti-renewables? Because they do not and cannot work. There's something called transformity, the transformity of energy, the quality of energy, the work that it can do. And it's basically equal to the amount of energy that's gone into its production. So coal has a relatively high transformity because the amount of energy over years that has gone into creating rainfall to grow the trees, to create the coal, etc. So when you look at renewables and you just look at them on the face of it, we're told that they're at grid parity or better, which is technically correct, but it's a low quality energy. So when we adjust for that, when we put it into a real context, so if you map out the Eurozone across Europe, the price each country pays for their electricity, official data from the Eurostat, you map that out against the percentage of electricity that comes from renewables. That data comes from BP World Energy Statistics, so again, pretty good. You get a very clear trend. And when you solve that trend line, you find that renewables is about 5 times the price of fossil fuel-based electricity. And that's because, as I say, the quality, we can look at that very easily. A solar cell or a wind turbine has to be rated. So a solar cell is rated at, I think it's 35 degrees north, to simulate 35 degrees north. It's sunlight directly overhead, 1,000 watts per square meter, to replicate 12 noon at 35 degrees north. Well, of course, around the course of the day, the Earth moves, so the sun, the intensity changes, etc. So when you put that into real context, Europe's overall capacity factor is about 18%, 11% for solar, 24, 25% for wind. So that means that your solar energy, so the grid parity is based on the assumption that you've got a lifetime supply of electricity divided by the capital cost of the electricity. But the problem with that is that 18% capacity factor, let's use 20% because my maths aren't very good. that means that your production is between 0% at one moment in time, in which case the electricity is effectively infinite price, to 5 times that average capacity, at which time no one wants it, so it's got to be dumped. So the quality is so low. That's why in real life situation, it's 5 times the price. And going forward, it's going to get more expensive, not less expensive. And the reason for this is because the solar cells, the wind turbines, etc., are being built at the moment with high transformity fossil fuel energy. They're it's that electricity, that energy building it. You go to using a low transformity energy as the source of this, you're going to see that basically the economy will absolutely collapse. There's just no way that it's viable. It would take us back to pre-industrial levels. And what's sad about this is a lot of people in the energy industry realize this, but they're getting government subsidies and happy to take those subsidies despite the destruction that's happening to the economy.
That's interesting you say that, because a lot of the energy companies, if you look at carbon capture and this whole thing, there's a lot of money flowing around in that, but
huge.
And it's almost like they're afraid to fight it. If they think it's real, they're afraid to fight it. I should say that.
Yeah, I mean, as I say, there's positive news that the UK has postponed by 5 years this, and I think why it's done this is, first of all, there was a local, some regional elections recently, and one in London, around London, and the Conservatives, I think, won it surprisingly because they basically were fighting against this renewable energy stuff, what's called ULEZ or ULEZ in the UK, which is a charge on petrol engines, etc. So I think that's part of it. And then secondly, we had failed wind auction. There was zero demand for an offshore wind auction. Now, remember, the companies are being subsidized in these auctions. So, it really highlights just how uncompetitive it is, that even with the subsidies, they can't make it work. And you have failed auctions, as you mentioned earlier, in Gulf of Mexico. There's been solar auctions that are not working. So it's the economics are starting to bite politically. So
you see fossil fuel as is maintaining where it is, or going higher over a period of time, I'm assuming.
Fossil fuels obviously have problems, which is they're going to run out at some stage.
Yeah.
And I don't think personally that they have a huge lifespan left. Shale production has been falling the last 3 or 4 months. Shale well productivity has peaked in shale well productivity is back to where it was in 2018. It has gone higher, it's come back lower. So I think there's shale, which was obviously the big driver of energy, oil production and gas production growth globally. I think that's starting to turn down. There's probably more oil in the short term because Saudi, Iran could come back on stream, Venezuela, but it's going to cost a lot of money. But I think, yes, it's going to continue to grow in the short to medium term. If you look what's really happening, whilst the West has been saying, we're going to go into renewables, we're going to give up on fossil fuels, fossil fuel demand is continuing to grow at a steady pace. It's just that it's going to the rest of the world, and that's where we're seeing GDP go. So the sort of economic political decision is being taken by the markets. People are going where the fossil fuels are going, not into the Western economies.
So do you see that as being an eventual pretty tough energy crisis, just overall?
Well, yes, I do, but I also see, and let me be honest, I'm an investor in this. I think nuclear fusion is the solution. I think it's an easy solution. I really think it's a relatively easy solution. Fusion has this sort of this idea that it's been 30 years away for the last 70, 80 years, which is true to one extent, but that ignores the fact that there is a calculation that shows a progression that shows how the technology has advanced. That's called the Lawson's number or triple product. So to get fusion, you want to slam atoms together. The problem is, to do that, you heat them up to give them the energy. But of course, a gas will expand, so they'll move apart. So what you've got to do is contain that gas. And it's obviously, we're talking 100 million degrees, so you can't contain it other than through magnetic confinement sort of thing. So if you contain it, the longer you contain it, the more chance the atoms slam together. So multiply confinement time by temperature, multiply that together with the density of the gas, more gas in that confined space. That's called the triple product or Lawson's number. That has moved up faster than Moore's law, and it's at energy break even. So we're at that stage. The problem is, so the private sector's taken up the role of this. The problem is the funding is so poor for it.
And in the U.S., we should have it, but they just won't do it. And if you look back, if they were thinking ahead, obviously the ability to have a safer nuclear plant today is much higher than it was, 30 years ago. So, I think they don't take that in consideration either.
It's the only future we've got, as far as I can see. Fission as a starting point, and we can up the quality of that dramatically. We can go to small modular reactors, but literally the fusion, I think, if we had, I reckon even a 10 billion budget, we could have fusion. We could have it by now if we wanted it. That's the reality. It's just that we are not putting money into it of any scale.
So I'm going to jump subjects on you here after talking about. That's very interesting. Everything we've been talking about. But if you look at today's and finishing up on today's stock and bond markets, and one of the graphs you have, which I really, really found interesting, was a total return graph on the bond market and the S&P, and it had some interesting spots on it. And I thought you might talk a little bit about that, where we are today relative to that.
So the chart starts 1980, and that's just, that's the sort. I think that's actually where you can get the 30-year bond yields from. What you find is that if you do a total return chart, the 30-year yield, 30-year bonds against the S&P total return, they've moved pretty much together, as you would probably expect, to be honest. But they've diverged aggressively over the last year or so, with bond yields obviously going up, so total return on bonds going down heavily against the S&P. And we've had this on this basis once before in 2000, not of this scale. And as I was mentioning earlier, we obviously had it on a much smaller scale in 1987. So in 1987, 30-year yields in the 6 months to the crash jumped about 25%, 7% yield to wherever that takes us. This time, over the last 6 months, they're up about 22%. Now, let's be honest, we've had them back up further over the last year, 2 years, etc. But the point is, we've not had this sort of divergence between equities and this until this point. I mean, it's obviously timing, etc. But the Fed's just way over tightened policy. The economy is going to slow, and there's just no way that earnings are going to be sustained. So again, if you think about back to money supply and that nominal GDP figure, if we think about corporates, well, if we look at, first of all, at government stock of debt, the interest rate on that has gone from 1.57% at the lows last year, February last year, to, I think it was 2.84% in July and 2.92% in August. As the government started issuing more debt, borrowing heavily, and they roll over the more debt, that interest rate is going to go up. So that's lifted the interest bill as a percentage of tax revenues to the highest since 1995. Move on to the corporate sector. So the corporate sector, and this has been made famous by one of our competition, Albert Edwards, freely available on Zero Hedge and what have you. He's highlighted that the corporates have benefited from the inflation, the nominal GDP boost over the last couple of years, benefited enormously from that, so that's their revenues. And against that, their costs in terms of interest costs have not gone up at all. This is the S&P. And the reason they've not gone up is because their stock of debt was such maturity, etc., that it's not been rolled over, or the cost of rolling it over is offsetting something that was mature, that was issued when the interest rates were equally high, etc. The problem they've got now is that nominal GDP growth is slowing aggressively, as we've said. It's already down to 4.1%. I'm thinking it's going to go a lot lower. At the same stage that their interest bill is going to start going through the roof. So they're going to get squeezed very aggressively. So when you take account of that, and obviously the same is going to happen at household sector. So household, we've got at the moment the home affordability ratio, housing affordability ratio, is the lowest since records began in 1986. And it's fallen off at a cliff in recent sort of periods. Actually, that data is last updated at the end of Q2, since when bond yields have gone up, mortgage rates have gone up quite heavily. So it seems sensible to me to think that corporate profits could fall very aggressively. So back to your chart of the 30-year total return, the total return on 30-year bonds against the S&P total returns, the overlay would suggest, theoretically, that the S&P could fall to 2,000. Now, I don't think that will happen at all. What will happen is that the Fed will respond, bond yields will start to fall aggressively, and they'll meet in the middle somewhere. So 3,000, 3 and a bit thousand. But it does suggest that the S&P is well overvalued at the moment, and it's a very high risk trade to be long the market.
Well, and the other thing, it's interesting you're talking about the earnings, because we've been under basically we thought that people were overrating earnings per share on the S&P, and yet, Andy, if you look at the last 3 or 4 months, Wall Street keeps raising their estimates on S&P earnings. We felt like they're going to eventually fall to 200 or below, and they've got the estimate up around 230, and we can't quite figure out what they're looking at, because it looks like business is slowing. And like you say, when they roll over debt, that's going higher. So that's a squeeze on both ends. But yet they keep raising their estimates on earnings for this year.
You've had the same in the real GDP figures, that the idea of a hard landing has disappeared, all that kind of thing. I just think that, again, you and I have been in this industry long enough. Realistically, what drives the market? If it's a blue screen, i.e. positive, people are positive. That's it drives itself, sort of thing. So again, this is an interesting aspect. You mentioned before this about employment, and James, my colleague's done some charts on this. He highlights that unemployment picks up when you get into a recession. It's not before, it's a lagging indicator. And I think that's, again, part of the issue. We will see unemployment jump aggressively, but it's not until the economy's actually in recession, and the companies which have been, spending heavily, etc., they're squeezed by their higher interest rates. Then they will be laying people off. And that then feeds back. It becomes a vicious circle until the Fed breaks it with lower interest rates, which is going to have to. So
if you were talking to someone today about allocating money, which direction would you go?
Do you know what? I would personally be looking to take advantage of bond yields. I seriously, they're obviously a risky bet with the Fed against them, and so you're taking a bet against the Fed. But what's 10-year yields now? 440, 445, something like that. I think that's a good long-term, a good sort of hold. Again, back to the sort of structural issues of GDP trending down for decades, you also have the same if you look at real yields, as in 10-year yields discounted by the PCE deflator rather than the index-linked market, which is obviously looking at 10-year inflation forecast. That chart has been trending down for a long, long time. And I think that's going to continue to fall for the reasons government is going to get bigger. They're not going to basically shrink. And so we're going to become less productive. So you're going to need lower interest rates to carry the greater debt, to carry the bigger government, etc. And people will say, well, hold on a minute, more debt, bond yields are going to go up. Well, hold on a minute, if debt is rising relative to GDP, that's your equation, isn't it? It's the nominal return on the bond yields. They're going down. That's what it effectively means. So I think, yes, you go long treasuries at the moment. I wouldn't be touching gold, quite frankly, because I think there's such a monetary contraction going on that that's going to be caught in it as much as anything else. And I would be very cautious on equities. I'm not supposed to give investment advice on single stocks or anything, but I would be literally lightening up and being as underweight as you sensibly can.
Well, listen, those have been really interesting comments all the way around today, I have to say. And I think we'll be running a stream at the bottom here, the best way to get to your firm if they want to use your services or want to contact you in any way. And I just want to say, Andy, you have a wealth of information. You've been around a long time, and that's a little different from...
A lot of people will say it's useless information, but...
Well, what happens is we've been, a lot of people in the industry today have never seen one of these changes, where you shift into a different mode. And I think that's what we're people are losing sight of today. But I want to thank you very much.
My pleasure. Thank you.
We hope to have you back again next year for sure.
Thanks very much.
All right. Thanks, Andy. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.